All right. Hello, everyone. I see people are starting to connect. We have a great presentation for you today. I hope everybody's having a good start to their day. Just give us another few moments. As always, I like to give people another minute or two to properly connect because I know sometimes it takes some people a second. So we want everybody to be able to see the entirety of the presentation. But again, I appreciate everybody who's joining right now, and we do have a great presentation for you today. So very excited about this one. While we're waiting for people to connect, I just want to make sure everybody has the ability to use the chat and Q&A functions. Um, Mainly the chat functions. Oh, just had to change that over. Perfect. All right, I appreciate everybody's patience. Just another minute or so. All right, that should be enough time, and I'll just go through my intro slides, and people who are connecting should be able to connect by the time Brandon starts his presentation. So here we go. Hello, everyone. My name is William Mucker. I am a client executive with Camaplan and would like to thank you all for joining us for today's webinar, How to Find Value in Overvalued Assets, Today's Case for Precious Metals with Brandon Green of Neptune Global. As a quick note, please be aware that Brandon will be sharing his contact information at the end of the presentation. So if you have any questions regarding precious metals, please reach out to Brandon and his team. If you have any questions regarding self-direction, please reach out to us. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products, and we will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open that account, fund that account, and facilitate the transaction into that investment. Like I was saying earlier, here's my contact information. If you or anyone that you know who you believe can benefit from the information today have any questions about what is discussed and how it applies to self-direction, please do not hesitate to contact me. I'd be more than happy to help. And without further ado, I'll pass the controls over to you, Brandon.
All right, sounds good. So I'm just going to click on my share screen. Oh, so here we go. Share, and we'll go with the presentation mode. How do I have to switch it up?
Yes, sir. You have to switch it one more time.
All right.
All right, looks good to me.
How's that? Okay. Excellent. Welcome, everybody. I'm really excited to actually see that we had about over 40 registrants this time around. I'm Brandon Green I'm a director of wealth sales business development for Neptune Global, Neptune GBX. So we're going to go over today the metals market and some other exciting things that are happening. I'm super excited today because metals are moving really rapidly. We have them up again. So let's get started. I am going to quickly just point out that you guys, Will has done his. We have a quick disclaimer. It's something everybody's got to do. I'm not going to read it. Let's move forward. I like to start off my presentations with a couple, one or two very famous quotes about metals markets. This time around, I'm using Thomas Kaplan. He's a legendary portfolio manager and resource investor out of New York. He once said, if the world does well, gold will be fine. If the world doesn't do well, gold will also do fine. But a lot of other things can collapse. And that's kind of where we stand right now. We're not really sure what's going on. We have big problems in the Middle East. We have debt problems. We have arguably elections that could go either way. That's causing a lot of frustration. And gold could do whatever happens, gold will be fine. and we have a lot of reason for it to do very well. And we're going to talk about that in the coming slides. And one big one I've always loved, and us in the gold industry do, is that JP Morgan has always said gold is money. Everything else is credit. It goes back to 1912, but it's a very valid point today. Okay. So let's see what's happened since our last webinar, which is about 6 months ago. So we had gold hitting a whole, gold has now hit an all-time high. Today it's about 2680. I think it's another $10 up. It might be almost 2700. We had 400-ounce gold bars hit $1 million for the first time in history. Those big bars that you see, the Fort Knox, the Queen Elizabeth, looking at them, all those giant bars, we like to see all those pictures are, those have finally hit 1 million. They hit 1 million back in 2500, which was nice, you know, that they're retaining their value and gaining value in time. The debt has risen 500 billion from 34.5 trillion to 35 trillion. We're going to talk about what the debt's been doing in a later slide. And silver has been steady and hovering and staying above $30. And we're going to talk about that $30 mark towards into the gold price of around 2,600, which is the ratio. So, little quick brief agenda. Going to go over why gold and precious metals, the market as a whole, what where gold's used, how it's used, where it comes from, and so forth from there. Its role in a modern portfolio. We did some analysis in allocating it to a modern portfolio. Some key factors of why gold and silver are undervalued using historical pricing, inflation adjusted, and so forth from there. And we'll just do a brief Neptune partnership company overview at the end. So why gold? Why precious metals? We need to know why. So it's an undisputed form of wealth preservation for 5,000 years, longer than any asset that you and I have ever seen in our lifetime. Our houses, our crypto, our stocks, our bonds, our private investing, it's got an undisputed form of wealth for longer than that. It's proven, it's still here, it's not going anywhere, right? It's outlived all paper currency, right? We only know dollars, pounds, pesos, whatever it might be. It's outlived all of those and will continue to do so. Has no counterparty risk of its physical nature. And what's important is it's liquid, portable, and divisible, which gives it that track record in currency and unit of value. It's universally accepted. You can go anywhere in the world. You can trade it or you can get the currency for it. That's very important for store of value and protection. Okay. And every central bank holds it. Okay. And you should too. If every central bank is holding a little bit, you should too. So I'm going to go over a little bit of the types of precious metals that investing that's available at the moment. So what you see here is the typical coins and bars in the beginning. Can you see my pointer, William? Can you let me know?
Yep, we do see your cursor.
Okay, okay, sometimes you never know with those. So coins and bars in the home, one of the oldest forms, taking it in, you know, having it in your safe, under your bed, wherever you want to put it. Some issues with that is that it's, you know, it's not so liquid, but it's in your home and it's not that safe, but you have a direct ownership. You don't get any income from it. Okay, and it's delivered to you. Next important, which we feel is important, is to put some in the vault, especially when you're holding significant amounts, okay? Very liquid when you have coins and bars in a vault. Some people offer direct, some don't. We have a direct holding, your name's on the bin, in the vault, with us and with them. Does not provide income, and you can get it anytime. ETFs are definitely liquid, but you definitely don't own the underlying metal. Your name's not there. You're not going to get any income. And quite honestly, if you want to get those delivered, it is very much a pain. And you have to have large amounts, millions in assets to get those delivered in most of these ETFs. Our vault accounts, which we've created and patented, provide much better liquidity, direct ownership, deliverability, and also there is income options out there in a private sense, which we have on a secondary scale with us. It provides you all of these. You can do gold by selling and buying options in an active sense, in a private investment way. Those are available, but that actually can happen. So I wanted to go over these types of precious metals investing. It's important to know what kinds are out there before you're understanding why. Okay. Let's talk about the whole gold market right now, okay? Jewelry actually accounts for most of it at 46%. It's an incredible market. I mean, obviously, we've heard about India every year and China, and obviously engagement rings and earrings and necklaces. Jewelry's a huge part of that. Central banks hold about 17%. And bars and coins actually represent around 21%. And then second from that is the physically backed gold ETFs, which actually only hold 2%. You hear about them all the time. They only hold 2%, but that's okay. We're not investing in those. And the next is financial institutions, and about 15% of those, primarily industrial applications and different things like that. Here's a different way we can look at it, right? The source of demand. You have jewelry and technology in the expansion phases. You have investment for uncertainty, and central banks are holding it for both. Now, I'm going to do a major asset class breakdown. So, in the world, global financial assets is about 266 trillion, right? According to the World Gold Council. Only 1% of that is invested in gold, right? So debt securities 45%, equities 44%, alternatives 5%. I'd argue alternatives are getting closer to 10 lately. So this just shows that only 1% in gold. Even if we just had a fraction move in to gold, we could see gold increase exponentially, and silver and platinum, palladium. But you need to put in perspective how much the gold market is in the world, and with the uncertainty, if it really starts to move over, we could see significant gains in that market. What surprised a lot of people is that gold is second daily notional trading value of lots of these major markets. The S&P 500, the American market, yes, is the largest, a little over 250 billion a day. But gold is just kicking there, right? We're about 160 above T-bills, the euro, the Dow Jones, some US corporates. It's a big market. So it's liquid and it's definitely has its place. One important thing to look at is, how does your asset perform during a crisis? These happen. We've all lived through them. How are gold performing? How are the other assets performing? Well, here's how it's looking. If you look, many of us remember the dot-com bubble, 9/11, recession, debt crisis, Brexit. It's pretty arguably recent. COVID is recent, in the 2022 pullback. You look at equities and all those, we're averaging a negative 1.5%, 2%. Bonds are going to do well in those times as well, but gold absolutely outperformed all of these times. So when you're looking for protection and you want to have that in your portfolio, this is proof that gold actually protects you during these types of vulnerable times. How about post-crisis? Well, here's the same thing. We got post.com, post 9/11, post-Brexit, post-COVID-19, post-2018 pullback. It just shows that, yes, there's a few times that gold has underperformed a little bit, but the average, it's going to come back. It's going to come back. What's been happening a lot lately is we've seen since 2009 that central banks are very much buyers of gold. They have not stopped. We see it in the news every day, not every day, every month. We hear about the reports. Central banks are buying. China, Russia, Brazil, the BRICS. Central banks are net buyers, and they're not slowing down. So this is where you can see in 2009 when they became net buyers pretty rapidly. Financial crisis, of course, 2008, 2009. So we're not seeing them slow down. These people are smart, smarter than me, smarter than everybody here. They know what's going on. So this is absolutely happening, and there's been no indication of them selling. And if we look at the People's Bank of China, they have been rapidly going since 2022. Okay, right here. And they really started pushing it. Okay. We were talking about ETFs earlier. As good as they are for holding and trading and going in and out, they have their place, more so for a trading aspect, quick ins and outs. What's happening though is people are they're taking the bullion out. This blue line is the gold price, but this black line is the holdings. There have been withdrawals, and the only people who can withdraw from these are giant participants, big investment banks that can take out 10 million or more at a time. Arbitrage, or maybe they have clients that need it. Either way, it's been in decline since mid 2020. We can see here. So people are wanting the physical. That's what they want. They want the physical, and this shows that they're getting it out of the largest gold ETF out there. We talk about cycles. Cycles are important. There's people that use cycles for all types of investing in the regular markets, in commodities, industrials, all types of industries. They use cycles. Our friends at MKS PAMP, who's one of the largest refiners and minters in the world, have been looking at this, and they believe we are in the third gold cycle right now. They believe they're going up, it's going up, and it's going up all the way. It's continuing from there. We have our first gold cycle ending in the 80s when Hunt Brothers and so forth from there. Then we had another one through 2000, came up until about 2010. It was a huge bull run. And now we're in another cycle, another cup, and ready to take off. Who knows where it's going? We're going to talk about where the prices have been and where we believe they're going to go. But cycles matter. Our world revolves around those. We're a macro environment. We're in the third major one right now. So we need to hold on tight and stick in for the long run. I'm going to talk about gold producers. Gold producers, obviously, they mine the product, they send it to refineries, but they need to worry about price. They can't handle price volatility. They need to pre-sell their product. So I know this is a big chart with a lot of different lines and boxes. I'm just going to show you exactly what this means. Blue price, blue line, gold price. The red line is how much they're hedging, their futures position, how much they're selling their gold in the future. Lately, they are well at the bottom, barely hedging at all, right? Since 2022, they're barely hedging. They believe that this just says to me, I'm not going to speak to them, but that says to me that they are hedging. They are not hedging their future price. They believe that the price is relatively stable, and possibly it could be done in the future. Like they sell product that's going to be mined for 1, 2, 3 years down the road, right? You can buy futures for many years out, and this is what it's used. This is why the futures market was created, to do this for gold, agriculture, everything. Now it's evolved into more speculation on a lot of other assets, but the futures market was created for producers in commodities so they could sell their product in the future at a price. And if they aren't doing that, they are willing to take more of a risk now by not doing that. That's saying that they believe the price is going to be higher down the road, or at least stable. That's a good bet to me. Debt is important to understand. Gold and our national debt are highly correlated. Okay. Jet to GDP, just jet debt in general, they are highly correlated. The gold increase along with the debt, since this is a chart since 2000, you could go back more. But at the moment, we're adding $1 trillion debt every day. Okay. So on a percentage basis, gold has increased by approximately 21% for every $1 trillion of US debt. So let's look at that. Let's look at that, okay? The US national debt was in year 2000 was $5.7 trillion. The gold price was 280. That's right. 2,700 now. It was 280 in 2000. So now we have a US debt of around $34 trillion. Gold price around 2,650. I know it's always changing. I can do this presentation differently every single day, but that's where we're sitting. That means gold has increased 30% for every $1 trillion of debt added. But here's an interesting fact, and you can find this various articles on this. We're adding 1 trillion of debt every 100 days right now. So we have gold increasing 30% every trillion, but we're adding $1 trillion every 100 days. What are we in for the next year? So it's definitely something to keep in mind. The debt is not stopping. They're adding to it. Doesn't matter who's in power, the debt is added. They talk about reducing spending. They've always spent, and the debt continues. You need to protect yourself. And if you take a look at how the debt and gold has correlated throughout the years, it's one way you can protect yourself from that, okay? Next, we're going to look at gold in a modern portfolio. Okay, this was done by our portfolio manager on one of our private placement sides, JMN Investments. His name is Nick Kersnick. He analyzed adding a gold to a portfolio and where you're doing it with the standard deviation. So he just took, instead of doing 60-40 bonds or 90-10 with the 40 bonds or the 10 bonds, he had a 10% allocation of gold. And then up and down this sliding scale is going more into stocks, less into bonds. But you're adding the 10% gold allocation. As its standard deviation, the volatility increases because you're adding more stocks naturally. It's a more volatile portfolio. You see that the 10% allocation in gold increased it by about 0.5%, 75 basis points. And brought it down a little bit. So what we take out of this is that just adding a little bit, we would never say go all gold, never say go. It's just you need to understand that adding 10% gold can significantly increase your returns. This is a return every year. So your overall portfolio is protected, decreases standard deviation, increases returns. When he was doing this for the stress periods since 2000, these stress periods, when inflation was over 2.5 times, debt to GDP was increasing by 10% or more. You could see that gold did very well compared to the S&P 6-month treasuries, 10-year treasuries. This is something that you need to take a look at a little bit closer. Happy to go over it with any of you afterwards. But one thing that's important is in adding it to a modern portfolio increases your returns. All right. Unless you go all the way down to the bottom where you're doing more bonds, you just don't get any returns really. So I want to talk about gold making new highs. We often hear about how gold, it's hitting a new high. You got to wait. And that's proven not to be true. Here's a look at how gold's performed over time, right? In 1974, $200 for the first time, 850 in 1980. We had a peak there. Financial crisis, 1,000. In 2011, we hit about 1920. COVID 2070. Now we're hitting 2650. Any one of these times you could have just said, oh, it's a new high, I'm going to wait. Nobody can time it. I urge you never to try and time it. But let's take a look at timing and how many times it has hit new highs. So since 1970 has made a daily high 319 times. So 319 times you could have said, okay, I gotta wait. Still would have been lost out on all those gains. Past 30 years, 218 times. Last 10 years alone, 68 new records. So there's no proof that waiting works in your favor. There's nothing. It has consistently over time made its way. Will it happen in the future? There's no guarantees. But if we look at history, timing the market is a myth. It's a complete myth. Now, talking about gold, I want to move on to silver because this is where you find an incredible undervaluation. So this is a nominal chart. So silver in special times, we have here 1980 and 2010, 2011. Between the LBMA close and the US market spot close, we had a $50 high, right? We're sitting around $32 right now, but we had a $50 high twice already. So we're well below it just in nominal terms, right? The actual price posted that day. This is a monthly chart, so it doesn't show, but there were between the LBMA closes, the fix and the US market, it was give or take a couple dollars, around 50 in these markets. I'm going to go back to gold for a second because we got to look at inflation adjusted highs. Okay. So in January of 1980, gold hit 850, which is about $2,700 in today's dollars, which we're kind of at right now. We are just getting up to the inflation adjusted highs. So we're making ground really quickly, extremely quickly. So we're looking at January 1980, $850 then. But if we're using inflation adjusted, macrotrends.com is a very good source for this, for their inflation numbers. We're kicking around 2,700. We're about at the same. But if we go back to silver, remember in 1980, silver hit $50. That's around $150 in today's dollars. We're nowhere near that. And I'm going to show you how we can get there based on a few simple factors, but we're nowhere near that. So if you're looking at silver or gold, I mean, gold has all reasons. It's definitely a longer term form of wealth and used in different ways, but silver, is definitely in comparison undervalued right now. And this is a different type of chart. This chart right here is a exponential chart. This one is just a linear chart. So you can see how silver is compared to inflation adjusted terms and compared to the current. Now, I want to talk about the gold silver ratio. For those of you who don't know, this is how many ounces of silver it takes to buy an ounce of gold. This is talked about a lot in the gold industry. There's a lot of ratios. There's Dow, the Dow ratio, Dow gold ratio. There's a lot of different ratios people use out there, right? It's common in the investment marketplace and portfolio management and modern. So right now, 80 ounces of silver, it takes approximately to buy an ounce of gold. That's kind of where we're sitting at. And you can see in this line that there's a huge resistance level to that. This is common because people look at this. They know how much silver is coming out of the ground. They need to go between gold and silver if they're investing. There's a lot of different factors to that, but we can see a natural line here of 80 to 1. So even if gold goes nowhere, we could see silver increase in value to it. So the ratio goes down. We have a huge area here since the 80s or in the 1970s of about 40 to 60 to 1. Then we have since around 1971 when it was taken off, the gold standard was taken off, we're around 30. Went down to 15, but we're around 30, 40, but we hedged around, we floated around there. This is important because this is a small part of recent history, right? This is a very small part of recent history for the entire investment market, right? We have centuries of this. So let's take a look at if the gold silver ratio closed. And we got to take a look at this. We got to say the ratio can close by either gold not moving and silver going up in value, or gold going down and silver not going down in value. That can happen because the ratio is at a high right now, and we can see that silver is more of it's a better bet. It's if the maybe gold will go down more than silver if the market goes down, or maybe silver will go up more than gold when the market's going up because of that 80-to-1 ratio is likely to close. Let's see what would happen if it just closed. Because we have gold at 2,600. A ratio of 80-to-1 that we saw was 3250. That's where we are. We're around, I know we're a little higher in 2,600, but for numbers and making it easy to see, this is kind of where we are right now. 2,600 is a good recent level. So let's just say we went between the 40 to 60 of the recent past 40 years, right? If we just went to that and gold didn't go anywhere, we would see silver go up from 35 to 100%, right? If they went up together, gold went up and silver closed the gap to 60-to-1, we'd see that move or more. Or if it went down, we would see in relation, it would be about 35 to 100% move. But if we went back to that 30-to-1, that would put us about $87 silver. That's 170% move up. Is this going to happen tomorrow? No, I am never going to say that. But if you look at a long-term, investment horizon, this can happen. So we're looking at we look at metals in longer term. We don't look at it as in short-term trades. So all this from the ratio closing and moving back to historical norms. One thing to point out though is centuries back. Silver was at about 15-to-1 for a very long time, coming up to up into the early 1930s and so forth from there, before it was on gold back and that. So what if we take a look at that? And I'm gonna bring an interesting number alignment. Okay. So very long term, very long century. We have the gold silver ratio about 15 to 20-to-1. It's 15-to-1 very long term. If we take some recent history, maybe it's closer to 20, but it's around that range. But we have the inflation adjusted high for silver around 150 that we've looked at before. If we take the current gold price of about 2,600, we use that 15 to 21 ratio, that's silver about 130 to 170. Which gets us at a medium of 150, which is right around the inflation adjusted high right now. So when I look at these numbers, it says to me that it's not a coincidence, or is it a coincidence? It just means that we could get there. It's when you look at money printing, inflation, and how you can put these together, maybe it can happen, or at least the risk of silver moving in towards gold. So gold going down more than silver going down, or silver increasing with it. If you want to change, okay, am I going to go into gold or go into silver? Well, there's a lot of reason to think, that gap could close in relation. Always have both, but it can happen. So it's just something to think about for that kind of stuff. So I hope these numbers worked for you. I'm happy to take on any questions, and you can email me and we can set up calls afterwards. This is where we see reasons that gold could always go up, not always go up, sorry, always has made new highs. And the reason to wait because of those may not work out in your favor. And silver has an extreme potential of increasing alongside with that. I'm going to just talk about a little bit about us now to close it off in our partnerships, so you can understand who we are and what we've been doing. We are a lot different than your average bullion dealer out there. Your online dealer, whether they have an online store or they do stuff differently, are we have partnerships that nobody else has. So in general, we are a full service precious metals dealer, but we work with wealth management industry as well. We service family offices. We have a suite of products that they use that we can offer to retail investors as well in your IRA or outside. Okay. We are one of the oldest bullion dealers in the USA. We were established in 2002. Okay. We have a platform that is unparalleled to others. We have transparency, liquidity, that you can understand that you have the gold. It's in its form in the vault. So our associations, we are partners of Fiduciary Trust, Franklin Templeton, one of the oldest wealth managers in the world. We are members of the DTCC, the Depository Trust Clearing House, where many trades are cleared. We are partners of multiple NYMEX and COMEX approved facilities. This is very important to be a part of these facilities, not, private little vaults that may not have these memberships and other institutional levels and auditors. We recently partnered with Pinnacle Group, who is a very well-known managing broker dealer in the wealth management industry. They looked at what we were doing and we're happy to take on that and work with their clients for precious metals. Our services and products, okay? We provide physical precious metals acquisition, two-way trading. We provide both sides of the trade. We're not going to leave you hanging. We will offer you gold. We'll get you the best price. We'll make sure that you get your right type of bar, coin, or vault account. And we will also make sure that you can liquidate when in need, because this is important to know. Our custodial services are very important. You can do this via your Camaplan account, via your Neptune Global, or via Fiduciary Trust International, which is that Franklin Templeton subsidiary. We have innovated and patented investment products that you can't get anywhere else. They are more cost-effective, efficient, and more efficient and cost-effective for trading when you're getting in and out of these products that you absolutely own, these gold, silver, and the PMC ounce. The PMC ounce is a mix of all four metals that gives you a much better risk-adjusted return versus gold and silver alone. And we can go into those details at any time. I have precious metal specialists that can explain that to you and can show you how it has a far superior level of return versus all four metals. And we do have some accredited income solutions that, if you are an accredited investor, we can talk to you about that. They have income as well. Okay. So a little bit more on the PMC ounce, how it's incorporated, its real-time trading, transparency, the visibility, and risk mitigating all elements, and it's cost-effective in an insured depository, completely backed by London bullion market, approved precious metals products. And each PMC ounce is a diversified position of gold, silver, platinum, and palladium. Okay. And Will, that is all.
Perfect. Thanks so much for the presentation, Brandon. A lot of great information there. And we appreciate your interpretation of today's metals market as it stands and what to look for in the coming months. If you have any questions regarding the metals market or any of the presentation Brandon just gave to you, please don't hesitate to reach out to Brandon and his team at Neptune Global. If you have any questions about self-direction and how it applies to precious metals, like I said in the beginning of the presentation, we're always happy to help. We have dedicated accounts for precious metals. We have dedicated reps to help you through the precious metals process, which we have streamlined a process for these precious metals purchases. And we always answer the phone and we're always happy to help. So I want to thank you one more time, Brandon, for all the great information and lending us your time for the day. And I want to thank anybody attending live and anybody who may be watching this presentation in the future. Brandon, thank you, and I hope everybody has a great rest of their day.
Excellent. Happy to be here. Thank you for joining, everybody.
Thanks.